Welcome to the webinar on secrets to getting your profit and loss statement ready prior to taking your business to market. By the way, this is part of Sunbelt's Exit Strategy series that we have been offering to our clients for the last 12 or 14 months. These webcast presentations are really here to inform you, the business owner, so that when the time is right for you to move on to your next venture or retirement, we want you to be well positioned to minimize taxes, maximize what you walk away with at closing. And I think today you're going to find by having clean and clear financials is going to really build the confidence in the buyer that's looking at your business. It's also going to build confidence in the lender that the buyer is working with, as well as the broker. I'm Joan Young, the president of Sunbelt Business Advisors. By the way, Sunbelt is the largest business brokerage network in the world. I believe we have 240 offices worldwide now. Our office is based in San Jose, and for over 15 years we've been helping sellers throughout the Bay Area to achieve their dreams of moving on to either retirement or other interest for the most profit. Today I'll be facilitating the webinar, and our guest presenters are John Young. He's Vice President of Sunbelt, who has valued many companies and advised them on building strong assets for the sale of their company. We also have another presenter, Matt Levy, one of our senior business brokers, who definitely understands the importance of P&Ls since he received his MBA from Wharton Business School, as well as been in many small business and gotten experience that way. We're going to leave 10 minutes at the end for Q&A. So if you'll notice in the far left-hand bottom box, you can put your questions in there, and then we will answer those at the very end. So today we're going to talk about three major principles. Principle one is planning. And you've probably, I'm sure everybody on the call has planned when you were starting your business, and now it's time to have a plan and a process for exiting your business, whether it's now or 3-5 years from now. If that is in the near future, the best time is right now to start planning, and the latest time to execute that plan is probably 2 or 3 years before you sell. Now, for some of you, you may already have everything in perfect order, and you would be able to move things along much more quickly. But the majority of us, I think this will help you know what's important to be ready. Second principle is going to surprise some of you, but every dollar saved on the tax return in tax liability, you will generate $2 to $3 times that amount in increase in value on the sale of your business. So John and Matt are going to talk about that. And then our third principle is to clean up those P&Ls and balance sheet prior to selling. And if you can have 3 years clean financials, is going to be even better. So I think John is going to talk to us about revenues, and that is the first area of interest. John, welcome. I think he's still on mute. Hang on one second. I think now we have John.
Yeah, am I live?
You are live. Would you like to start out with revenue?
On our end. Yeah. Nice to be here, and thank you so much. And we're going to address this, the financials here by just essentially looking at a P&L and financial statement. So first category, of course, is revenues. And one of the harsh rules that I want to start out with is stop taking cash or unreported income from the business. SBA lenders and buyers especially, they won't pay for it, and they really don't like it. It leaves a bad taste in their mouth when sellers say, well, I'm taking cash. Joan, I think you had an example of a client you worked with like that?
Well, yeah, there was a business years ago. We typically don't work with cash businesses anymore, but this woman was kind of winking at me and saying, Joan, I have a big Lexus, I live in the hills, so my business is making money, and she wanted much more for her business than the financials showed. I think her tax return showed she'd lost $20,000, and she was saying, oh no, I made more like 80 to 100, but it was all in her pocket. So, we couldn't get a lender to lend on that because they have to go by tax returns. So that's a good point, John.
That's a tough sell.
Yeah, it is, and we do see that not as frequently as we had before, but we do see it. And another issue is many business owners own two businesses, and the income is combined into one P&L, and that can be a very legitimate thing to do as far as tax returns go, but it confuses a buyer and a lender at a very crucial time in the process, and that's getting a loan approval. So it's better during this transition period to separate out the businesses. That could be done either by creating a separate P&L, but it could also be done in QuickBooks by creating a second class. So you could print your P&L with all the income posted, or you could print separate classes, one for the business that you're selling and one for the other business that you're running. And that's just a very clean way of operating and running your books. Those are two of the big issues that I see. Taking the next step down to cost of goods. This is an area that's often overlooked by sellers. They're looking at their P&L. They want to know what they made and what the expenses are, and buyers look at it that way. But a sophisticated buyer is going to take a good hard look at the gross margin, and which is the money left after you subtract cost of goods from the revenue, and it's a critical figure. If that's a solid number, you can make a lot of mistakes in running the business as far as the operating expenses and still come out with a decent profit. If your expenses are too high for your cost of goods, you can't make any mistakes down below in your operating expenses. So that's a critical area to watch. If you want to watch your purchasing and bulk purchases, and do what you can to make that as strong as possible. If your inventory costs are too high and labor costs are too high, you're throwing your dollars away. So pay attention to your acquisition costs. Make that margin as big as you can, and pay attention to it as you run through your books. And depending on the size of your company and the type of company, there are industry standards, industry reports that you can look at. It could be just a membership into a group in your industry, and they'll tell you what your margins should be and see how you compare to another company. That's a real good way to track your business in comparison to others. And guess what? Buyers are looking at your business in comparison to others, whether they're in the same industry or not. So pay attention to that.
That's a good point. So the bulk of what's important to most of our companies are the expenses. So how can you help here?
Well, first let's recognize that some companies listening in today are already well organized financially, yet they still will get some good ideas out of this webinar in preparation for sale. But in particular, it's the company or companies that have started from scratch. They've had a friend, maybe a bookkeeper, set up their books, trying to control their costs, and especially over the years, they've added to their business, but never really recognized that in the books and the way they keep the books as the company has changed over time. And now the business books can be confusing, especially to outsiders, and that's what we're concerned with. They can be inconsistent over the years. 2007, you posted things one way, 2010 another, 2011 another revision. During this period of preparation, this is not the time to make those changes. This is the time to clean things up and getting them run consistently and organized. We'll talk about how you can do that with your CPA a little bit later, though.
So, Matt, I think you had a few other things on expenses you wanted to cover.
Yeah. I think the first thing is really when you're looking at values, you have to understand that values are based on 3 years' worth of tax returns. So the key message here is to do a lot of planning. Start to clean up your P&L and tax returns 3 years in advance of the time when you want to sell your business. So again, plan ahead. Right now, the SBA is only requiring 2 years of financial statements, but that's only because of the recession. They understand there's been some hits that businesses have taken, and so they're a little bit more lenient. But in the near future, they're going to go back to 3 years. Irregardless of the SBA, potential buyers are going to want to look at a 3-year period as well. They're going to want to make sure that they can spot any trends and to make sure that the business is headed in the right direction. So think in terms of 3 years when you're preparing your financials. Another point is, you can see 1A is get an accountant. If you're not using an accountant, it's very important to get one. The cost of an accountant is far, far less than the increased value that you would get, or even not even just value, just the market desirability of your business. So it's going to be more valuable. It's going to be easier to sell by having an accountant do your books as opposed to your own. For larger companies, that might mean reviewed financial statements, so do audits. If you're doing audits, make sure that your last audit was within the last 2 years and not longer. And if it's been longer, then make sure you do another audit and have that unbiased, qualified accountant kind of give that stamp of approval. That's important.
And Matt, you mentioned another term, not audited, but what was the other term you used?
You mean review financial statements?
Yeah, the review. Mm-hmm.
Yes.
Okay, so that's what most people would need, wouldn't they, not the audited?
Yeah, that's less expensive than the audit, but it is a third party looking at the books. It's cleaning up any messes that bookkeepers make, and they do make mistakes, and it gives such a high degree of credibility to the books.
Okay.
That, now, we're not talking about a small business, but a medium-sized business in the main market would do great having reviewed statements. I think, Joan, you worked on a sign company that was a $2 or $3 million business. They had reviewed statements. Remember that?
Yes. Uh-huh. And the buyer, who was an M&A firm, they would have required it even if he hadn't. So. Mm-hmm.
Yeah.
Man. Okay.
That's a good point. Yep. It's a very good point. I think the next point is also relevant, which is use QuickBooks or similar software such as Peachtree. Most buyers are familiar with this format, and so they're going to want to feel comfortable that they can see something that's consistent and that they understand. So if you're using something like a spreadsheet, there's less validity in the data. They're going to question that. So use something that's kind of standard like QuickBooks or similar software. Also, the next point, categorize properly. So, for example, insurance should be subcategorized. So don't just have a broad category of insurance, but label it out. Auto insurance, travel insurance, life insurance, what type of insurance is it? Another important point on that is travel is different than meals and entertainment. A lot of times we'll see books and they're just combined. But if at all possible, it's best to break it out separately. Another one we see is salaries, where you'll have a broad category of salaries and everything put underneath it. But it's really important to break out the owner salary along with any salaries for family employees that are planning to stay with the business after you sell it. So have those in the separate categories so that you can track them clearly and demonstrate to a potential buyer that those aren't expenses that he or she would incur if they were to buy the business. And of course, be consistent year to year. So you don't want to categorize an expense in some category one year and then change it the next year. That just causes confusion, makes it worse when you go to try to sell it. Point number 2 is personal expenses. And so, as John mentioned earlier, the ideal scenario is don't have any personal expenses in your business books. That's the best thing you can do. Having said that, a lot of owners will keep personal expenses because they get the tax deduction. If that's the case, make sure you keep very good records of that, because you are going to have to prove that to a buyer that those are expenses in fact personal expenses, and that a new buyer is not going to have to incur those expenses. Even with that, the SBA or the lender is not going to account for those expenses. Even if it's a personal expense, if it's in the books, in the tax records, they're going to say you have to keep it in there. I mentioned maintaining consistency when categorizing expenses, so that's important. And then finally, make the books relatively detailed. So again, break things out not only in broad category, but have subcategories as well, that you can go ahead and line item everything and have it so that you can trace it very easily. It makes the process that much smoother. If you want to go to the next slide, which is the next point, and that is keep good notes on any prepaid expenses. So a lot of them that are common are insurance payments or possibly rent that you might pay ahead of time. If so, you're going to want to make a note somewhere so it can easily be adjusted in the valuation when it comes time to sell your business. So make sure you keep notes on any prepaid expenses. Then also, if you not only own the business, but you own the building, pay yourself a fair market rent out of the business. So actually transfer money from your business account to your personal account that shows the fair market value of rent. And that way a buyer can come in and get a really good idea of what the true costs are for managing the business. Do you want to add anything, John?
Yeah, Matt, that was good. Thanks. A few other issues that come up are during due diligence, buyers will want to see what the books look like and compare that to hard copy backups, and keep those well filed and keep those around during this 3-year period at least. You probably have things in boxes. That's okay too, but during this period we want it easily accessible so that the due diligence can go very smoothly. They'll come in and they'll compare hard copy receipts and contracts or leases to what you're posting in the books. Keep in mind also that what may be a legitimate deductible expense on the return may not be a necessary expense to the business, and those are two very different concepts. One might be legitimate. Your CPA will say you can legitimately deduct that, but is it necessary for the business? If it's not, we will be adding that back or adjusting it back in because that will be a benefit to a buyer. For instance, if you're driving a Mercedes or what was that car?
The Hummer.
The Hummer, Joan. And if you're writing that off in a business, but you can hop into a Kia and drive around because your job is really sitting at the desk at your office, try adjusting your books and writing off the Kia. Now, we can make that an adjustment in the valuation to show the difference, but again, banks are more conservative, and they'll say if you were driving that and got the benefit of it, they're not going to add it back. So you just lost 2 or 3 times the value on that what you wrote off. So Mercedes cost you $1,000 a month, a Kia $200. You're saving $800 a month, but in value of your business, that's really $2,400 more in the value of your business. So these are making wise decisions during this period of time. And if you can make them now, get started doing that, and it will come back to you when the business is valued. Another thing we see quite often, I see, is hidden expenses. Those are things like second owner's salary that is not separated out like Matt was talking about in detailing your books. Your CPA doesn't need that detail, and he'll tell you he doesn't, but it's a good idea. One, you can track better what your real expenses are, and the buyer can track what his expenses are going to be. So separate out a second owner, especially if it's a family member. We've seen think it was an aquarium business years ago, that the owners of that business were giving living expenses or actually providing a room in the facility for one of their employees. They liked the employee and it worked out well. Well, that's great, but the new buyer may not have that privilege. They may move the business, they may remodel, they don't have that room, and that's going to be an additional expense, and it'll be an additional expense right off the bat. So that's something occasionally gets hidden. Cars provided for an employee is a hidden expense. Real common is a spouse who's actively working in the business but being underpaid. Someone replacing that spouse is going to have to be paid fair market value. There goes the real bottom line of your business. Or son or daughter working in the business. People talk about doing that over the summer and bringing your kids in. It's a way of transferring money to them and writing it off. And hey, that's a great idea. However, if they're really doing a job that needs to be done, that will have to be adjusted at the end again. So if you want to do that, yes.
I was just going to say, I've been in many meetings where husband and wife are sitting there, and let's say it said the husband, the salary was $200,000, and we'd say, well, what about your wife's salary? He said, oh, she doesn't really do much. And she's sitting there, excuse me, I come in at 9 o'clock, I leave at 6. Yes, I do. And so then we need to see, okay, what would it cost to replace her for what she does, because we can only count one owner's salary, correct?
Yeah. Absolutely right, and that's not uncommon at all, where we've even seen where the spouse is discounting what he or she does in her own mind. And then you start questioning, and you find out, well, they really are doing things that are valuable to the business, and somebody has to pick that work up. Now, it could be an existing employee, but often it will lend itself to needing a new employee. So keep it clean. Again, we're talking about a short period of time in this plan, but keep it clean.
Okay. What about the balance sheet? I know they're very important to lenders, especially the SBA, as well as buyer. What's been your experience there?
Oh, you would have to ask about that.
Balance sheet's always tricky.
Yeah, that's always a difficult subject to deal with, because most people aren't paying attention to their balance sheets in small companies. Small business owners don't keep track on the balance sheet, or they don't update it. They buy a new piece of equipment and forget to post it on there. They're operating on credit, and they give credit to people, but they don't have it as accounts receivable, so they're running it looking like cash, but there really should be on an accrual basis. So the balance sheet is a valuable history of the business and its current status, and that's a real important point to remember. A strong balance sheet means a well-run business. Buyers like that, and that's what we're really designing this plan for, is for the buyer. So update and make sure your balance sheet is accurate. Discuss this with your CPA. They're going to help you out on that. Depreciation is an important point, to make sure that is posted on there correctly. If you buy new equipment or sell equipment, get it on or off the books, especially on the sale. A lot of times we see that piece of equipment was, if not sold, it's broken down and sitting in the back and has no value and shouldn't be on there. Be consistent on your inventory. Some of you have heard LIFO and FIFO, last in, first out, first in, last out. Be consistent over this period of time. Another point, if you've loaned money to the company during bad years, so to speak, some owners say, well, hey, I put $100,000 in, I'd like to be paid for it. That is not going to happen. Buyers are not going to pay you for you capitalizing your business. So if you have excess cash in any one year, instead of taking it as payroll, pay yourself back as a loan, your loan back, and take the money out that way. And another point would be to get it off the books before the time of sale, so it's real clean according to the way the SBA looks at it. And again, just quick mention of the accrual method of accounting, which takes into account businesses that have inventory and businesses that sell on credit. It takes a good bookkeeper almost daily to keep track of that. So if you're running that way, keep the books good. Keep the accounts receivable short. Collect your money. Good grief, seen a company recently that had just a few clients, actually, which wasn't good. The more clients you have, the better off your business is. But one of the clients turned around and went to Europe for purchases, and another client just turned around and went away. So you can guess what happened to the business at that point. So preparation is a whole lot better than recovery. Watch your number of clients and watch your accounts receivable.
Okay. Matt, did you have any other suggestions on that?
Yeah, I think we've been focused really talking about the financials, which obviously is critical. But I think there's also some other records that are important to look at cleaning up as well. And the first one you can see is payroll records. So obviously the payroll records should be accurate in your books, but also make sure that they match with your monthly, if you use an outside service, which most companies do, make sure that they match, the monthly report that they provide matches with your books. You don't want to have any discrepancy between the two. So clean that up first. Second thing is to get a company credit card. So last thing you want to do is commingle your personal expenses with your business expenses. If you do that, when it comes time to sell your company, you're going to have to bring in your personal statements and go through it. Just keep them separate. You get a separate credit card, keep the business expenses separately. Take a look at other documents like contracts, employee contracts possibly, leases or lease renewals, I-9s, account receivable, account payable. Make sure those are accurate, up to date, clean copies. When the buyer does due diligence, they're going to want to look at that. Number 4 is something I think that's often overlooked but provides a lot of value, and that is training manuals. If you don't have training manuals, I recommend putting some together, and if you have some already, make sure that they are updated as well as professionally done, easy to read. Buyers love the fact that they can get something that's documented and referenced even after you're gone. And so training manuals will definitely provide value to your business doing that. And the last point I've already gone through, but it's worth reiterating. If you don't have one, hire an accountant. Don't be penny wise and pound foolish. You're much better off getting an accountant and making sure your books are qualified, validated, and it'll make the sale much smoother.
Okay, thanks so much, Matt. I think
Sure.
The next point is, and I hope most of you business owners on the webinar are taking advantage of using your advisors. Remember that lenders will use the tax returns to value the business for loans. So if you save money on your taxes, you're losing 2 to 3 times that much at the end of when you're ready to sell. Lenders are far more conservative than buyers, and even more so than brokers. So we try to maximize the value of our business. Well, what we're trying to do is to maximize it while CPAs are trying to minimize the taxes you pay. So, if you've done it up until now, that's fine, but for the next 2 to 3 years, or at least 2 to 3 years before you sell, definitely do it the way that you've been taught today. Lenders will just tell you, well, if you've saved the money on taxes, you're not going to get the money again in a loan value. So you got it once and that's it. So if you can get your tax preparer to do a review of your books, I would say quarterly or semi-annually, so that you, the owner, are not the only bookkeeper looking at it. I think it's so important to have an external, unbiased review, and it definitely goes a long way towards making the books reliable. And then also have your tax preparer revise or adjust your P&Ls and just restore the corrected financials to your system so it matches the return. I know we had that mistake years ago. We had the tax preparer, did everything right, but we didn't transfer it over to our books so that they matched. So that was important. And let's see, Matt, did you have some other tips that you would like to share with the group?
Yeah. So I think.
Or was it John?
Yeah. I think we both had a couple things. One, I mentioned it before, but broaden your customer base. So one customer is not more than 10 to 20% of your business. We're talking about a 2 to 3 year period, and that's enough time to start broadening it. Spread your risk around, and the customer concentration is a major element in the value from both the buyer standpoint and the lender standpoint. And if you have equipment that needs replacing, be judicious, but if it really needs to be replaced, replace it. That will increase the value. It will increase the perception that buyers have of a well-run business. If it needs to be replaced, buyers look at it and they'll plug in a cost far higher than it might be. So their value drops in their mind. Keep your maintenance records on equipment that you have too. Buyers will want to see that, make sure everything is in good working order and that you have run your business well by taking care of it.
Yeah, and I think really, I agree, maintenance is key. And so you see the next point, which is if technology is changing, go with it. It's an old rule of thumb. Buyers don't want to purchase a 20th century business in the 21st century. You don't want to have the business look outdated. You don't want to have old equipment that's not functional. You don't want to have a buyer come in and have to make a huge investment or plan to take a significant discount on the value of your business because you have a limited buyer set for that. Next bullet point kind of feeds into that, and that is prepare to come to the party. What that means is to clean up, straighten up, put on your best, and make sure what's underneath is just as pretty as what shows. So the packaging is important. If you have a good business, you're running it well, organization is good, you want to make sure that you have a nice presentation of the business to demonstrate that. That'll get you an increased value as well.
And last point I'd like to say is have your broker, your Sunbelt broker, review your progress every few months to ensure the business is on track and moving in the right direction. You want to review your books yourself. Use your tools. Use your P&L and balance sheet monthly and track what you're doing. During this period of time, growth is key, and you want to see how you're growing.
Yeah, I think that's a really good point. I think, you can leverage our team that you heard today, and we'd be more than happy to give you advice and kind of help you with that planning process.
Okay.
Thank you, Matt and John. And, one thing I've just observed is that, it's so interesting how we will spend months and months planning for our big vacation that we're going to take. And I've seen people spend more time on a vacation than they do on planning their exit strategy. And, I always think of a pilot. A pilot is going to make several course corrections on their trips that they take, due to winds, weather, etc. And we should be looking frequently at our P&Ls, balance sheets, and even our business plan and see if there are any corrections that we need to be making as we go along due to changes in the market, changes in the economy, changes in the demand for your services. You may be offering X where really the market needs Y right now. So I think it's hopefully some of these tips have been helpful to you to start really looking more closely instead of just, when your accountant prints out your monthly financials is just putting it in the file drawer and not looking at it. It's so important, especially that the profit margins. So we're going to open it up now for Q&A, and was wondering if we had any questions for the presenters. I'm unmuting.
The conference has been muted. The conference has been unmuted. The conference has been unmuted.
I see one question here that said, should I stop writing off personal expenses like travel and entertainment? I think, John, you handled that one.
Yeah. Good question. Simply put, probably yes during this period of time. Just keep in mind that we're talking about a plan, short-term plan, and an exit strategy. So it would be best to stop writing those off. In worst case, careful about it and keep good records so that you can actually prove what is yours. We've seen people say, well, office expenses, 50% of it is for my personal use, and maybe we all could buy off on 10% or 20%, but 50, 40 might be too high unless possibly you have good records. So again, the bank doesn't like it, but the buyer might accept that. But it would be best not to do it during this period.
Okay. Another question, since my business is only 3 years old, does this mean the financials will not be credible or attractive? That's, to me, that's sort of the magic number you do need. You need to at least have 3 years. Of course, some people want to see more history, 4 and 5. 5's ideal, but there's many people that hit the 3-year mark and other things come up where it took more work and energy than they thought, and they're ready to move on to something else or to retirement. But Matt and John, would you agree that as long as you have 3 years, you're okay?
Yeah, I agree. As I mentioned, I think 3 years is the minimum, so as long as you have 3 years, you're good. And so I think the question comes down to is what do those financials look like? So were you able to do some of the things that we talked about today, which is keeping personal expenses out, or at least being able to track them, making sure you don't have hidden expenses, some of the other items. And if that's good, and that's all good in their clean books, then I think there's no problem, even if your business has only been 3 years old.
Okay.
And some people have told us that their business is 3 years old, and then when we get the information, it's really 2.5 or 2 years and 10 months, in which case let's wait for the final third year to finish and get the complete books. In the meantime, things can be done in preparation, but having that third full year tax return is what lenders are looking for.
Okay.
I think another important point to keep in mind is everyone who's presenting knows it takes a lot of work to sell a business. So you're not going to sell it in 2 weeks or a month, and so during that time it's being sold, people are going to want to know your updated financials. So, even if you're not quite 3 years, you can start the process, and essentially you can keep the financials up to date, and you should have everything in order when it is actually time to close the transaction.
Good point.
Another question was, what is the difference between cash or accrual accounting?
Briefly, cash accounting is used by small businesses, and you post on your books the cash when it's received, and you post your expenses when you actually write the check and pay it. The accrual method is a little bit different in that if you do a job today and somebody is going to pay you 3 months from now, there's a 90-day pay period, you would post that income today even though the cash would not be received until later. And likewise with expenses, if you purchase something and it gets delivered but the invoice is going to follow in 30 days, you actually can post the expense when that product is delivered, even though you won't actually write the check for another 30 days. And accrual accounting gives a better financial picture of most businesses because it gives you an idea of what is happening now and what is guarantee is a tough word, but guaranteed to happen in the near future. It's already, you haven't completed it, but it's going to happen, so you can see your expenses and your income stream almost in advance. There are a lot of other technical issues about it, but that's pretty much what the difference is.
Okay. One other question. It said, I have not officially taken a salary, even though I have 6 office people on salary and as many as 60 people on per diem pay. Does this make the business less valuable for sale without taking a salary?
John? No. Depends on what the bottom line looks like. The bottom line and the net income in the business is going to flow, if it's an S Corp or sole proprietorship LLC, it's going to flow to the owner. So the money's going to be there. If it's a C Corp, you probably should be taking a salary, whatever you can.
Yeah, it's not a C Corp.
Yeah. So a lot of small businesses, they take draws anyway. That doesn't show on the books that they're taking a salary. You don't take salaries in sole proprietorships. You take draws. So it doesn't really reduce the value other than the fact that if you're not taking the salary, is it because the income isn't strong enough?
Right. And then that would affect the value, of course. Yeah, because the business is it's typically the sale is going to be a multiple, depending on your industry, what that multiple would be of what that adjusted net at the bottom. So we wouldn't be able to add back a salary or any income to the seller, so it would be a multiple of any other adjustments that you've run through the business that was personal and plus the bottom line, and it would be a multiple of that. So if that number is really low, then the business doesn't have a lot of value yet. But that doesn't mean...
Keep in mind that, let's say this 3-year-old business is growing. The first year is never expected to be that good. So lenders will take that into account, and they'll look at the second and the third year, and they'll look at trends. And if trends are still upward, that's good. There's value there. It's not as high as a mature business, but if in the recent year your income is significantly more than prior years and it's good, there's decent value in it.
Mm-hmm. Well, thank you, gentlemen.
If I could just add one quick point again. The reason we're doing the webinar is we really want to educate you as a seller to be prepared, and so by all means, use us as a resource. We could do a confidential review and give you an idea of evaluation of your business beforehand and be able to quickly and easily look if it's something that we think is sellable or not, and we can tell you. And if it's not sellable for whatever reason, we can tell you why, and then you can plan ahead to fix it. I think that's the key point.
Great. Thank you, Matt. Thank you, John. I think we're at our 45-minute point. I thank you very much for coming on. We will make sure to let you know when our next webinar will be having to do with exit strategies. And feel free to call any of us at any time. And you have our contact information there. And hopefully it was helpful. Thank you so much. Bye-bye.
Thanks, Joan.
Thank you.
Mm-hmm.
Thank you. Please stand by.